Welcome back to our ASRS series. In this video, we will provide a detailed overview of the mandatory disclosures required in the ASRS Sustainability Report, including governance, risk management, and emissions metrics, as well as director liabilities. I'm Barbara Albert, co-CEO of 100% Renewables, a consulting firm specialising in helping our clients to decarbonise and prepare for mandatory sustainability reporting requirements. Before I start talking about the ASRS Sustainability Report, please make sure you also watch the other videos in our ASRS playlist, such as videos on carbon footprinting, climate risks and opportunities, developing transition plans, and climate metrics and targets. We've put the links to the playlist in the description below. Okay, let's get right into it. Let's dive into what reporting under Australian Sustainability Reporting Standards means for your annual reporting. Starting from the first year of implementation, your organisation is required to report on climate-related risks and opportunities. This includes mandatory disclosures on governance frameworks, strategic planning, risk management, and specific metrics and targets such as Scope 1 and Scope 2 greenhouse gas emissions. By the second year, you'll also need to report Scope 3 emissions covering indirect emissions from your value chain and financing or investment activities. The ASRS Sustainability Report becomes a critical part of your annual report, sitting alongside the Directors, Financial and Auditors reports. If you're already producing a voluntary sustainability report, you should consider integrating or aligning it with the ASRS requirements. Include an index in your annual report to help stakeholders easily navigate to the climate disclosures. Remember, the ASRS Sustainability Report must be publicly available on your website the day it is lodged with ASIC. Your sustainability report will include a detailed climate statement covering material climate-related financial risks and opportunities, governance and risk management details, controls and procedures, and the metrics and targets related to climate, including your full carbon footprint. The responsibility for climate-related reporting extends beyond the ESG team to include directors. They must declare with certainty that your sustainability reports are in compliance with the Corporations Act and ASRS. This declaration ensures that directors engage fully with their disclosure obligations under Australia's robust legal framework, which includes traditional directors' duties and obligations to avoid misleading conduct. An interesting aspect of ASRS is its approach to materiality, especially for Group 3 organisations. If there are no material climate-related risks identified, a simple statement indicating this fact is sufficient, though a director's declaration is still needed and audit requirements apply. To ease the initial transition, a modified liability regime will be in place for the first 3 years, limiting regulatory actions related to non-compliance on Scope 3 emissions and forward-looking statements to injunctions and declarations by the regulator. Compliance with ASRS is just the beginning. Embracing voluntary frameworks and initiatives like the GRI, the SDGs, TNFD, SBTI, B Corp and Climate Active can further demonstrate your environmental leadership and commitment to sustainability. In the next video in the series, we will explore those additional voluntary frameworks and initiatives. So stay tuned and subscribe to our channel to ensure you receive the next video in this series as soon as it's released. Thanks for watching.